and welcome to the Canadian SME Small Business Podcast, where we bring you insights and expertise to help small business owners navigate the complex world of finance, strategy, and growth. I'm your host, Maheen, and today we have a very special guest with us today, Daryl Ching, CFA and Managing Partner at Vistance Capital Advisory. With his unique background in investment banking and small business executive roles, Daryl brings a wealth of knowledge to help bridge the gap between small businesses and the capital they need. Today's episode is all about understanding the worth of your small business and how accounting can play a pivotal role in maximizing its value. But before we dive into that, let's learn a bit more about Daryl and the services Vistance Capital Advisory offers to small businesses in Toronto. Hi, Daryl. Welcome to the Canadian SME Small Business Podcast. How are you today?
I'm doing fantastic. How about you, Maheen?
Very well, thank you. Without further ado, Daryl, we'd love to hear a bit more about yourself and the business, and how is it catering towards the market here in Toronto?
Well, thank you, Maheen. My background was actually in investment banking. I started my career at RBC Capital Markets, and I launched my business primarily as a capital raising business to help companies with equity financing. But it is through that process that I discovered that a lot of people struggled with accounting.
Right.
And in fact, several deals that we were bringing to the table with investors during the due diligence process fell through because we had clients that had poor financial statements.
Right.
And that's when I discovered that there was actually a very big need for accounting services, especially for small businesses, that they were not getting. And the service that is available for small businesses in Canada is primarily tax services. It's annual tax filings. But who's giving advice in between in terms of managing cash flow, in terms of calculating gross profit margins, telling a business owner how they can improve? Those services are just not available. And so, I decided to expand my business into accounting. As an entrepreneur, we pivot based on the needs of our clients and based on what we hear, what we see. And we expanded our services, and we've morphed really into a full service accounting firm now.
Wow. No, it's very well needed. And your platform is very resourceful as well in terms of, what small business owners need at this point in time. Daryl, we'd love to hear about some of the key factors that small business owners should consider when trying to determine the worth of their company. And what are some common misconceptions about business valuation?
So, the biggest misconception, in my opinion, is the fact that I can run a discounted cash flow model and there's some magic formula to get me an evaluation. Unfortunately, when you're not profitable, when you're early stage, that isn't the case. When it comes to valuation, I think there's really two concepts I want to focus on. Number one is the management team. And it's, making sure that you've checked all the boxes, that in your full management team, you've got people that are good at sales and marketing, branding. If you're in distribution. If you're in manufacturing. But basically, you've got somebody strong in every important facet of your business where they can advise on each of those areas. That's vitally important because if you think about what people are making a bet on, the investors are making a bet on a team more than anything else. The second concept I want to push is proof of concept. And really, if you want to sum it up in plain English, it's how far along are you?
Right.
And I think that when you sit in a room and you watch a bunch of investor presentations, you'll see that a lot of people are very good at portraying their ideas, their vision, the size of the market, the size of the opportunity. But then when they stop there, the question then becomes, well, then are you still at the idea stage? Or how far along are you? And the answer to that question really is in proof of concept. The best proof is revenue.
Right.
So if you are generating revenue and you're charging full prices, that is the best proof of concept. Without it, I see comments in investor presentations like in discussions with. And it's, well, how far along are you in discussions? Verbal agreements, they're not worth much. So it's, can you get a contract signed? So if you're pitching a partnership, can you get a contract signed? If not, can you at least get a letter of intent signed so that there's a documented proof that there is an intent to move forward with a project, with a partner? And I think those little steps are vitally important in moving the process along and convincing of an investor that this opportunity is actually real and will come to fruition. So those are the two key concepts to me: is management team, proof of concept.
Right. Well, let's tie all this to emotional availability of small business owners as well, because most of them tend to often develop an emotional connection to their companies, which is a valid thing to do. But Daryl, how can they separate their personal feelings from the objective process of assessing their business value?
So, Maheen, you're going to be surprised at the response. They can't.
Yeah.
It is virtually impossible. When you start a business, an attack on your business feels very personal,
right?
And it will feel that way. But the key is to know that and to mitigate that as much as possible, and know that every decision you're going to make is going to be highly emotional. So one of the things you could do is bring in independent advisors that are unbiased, that can give you an unbiased opinion and understanding. They look with that lens. I've been brought into situations with breakup of partnerships. I've been brought into situations where there was a dispute over what the bonus structure should be among a group of executives. And often I thought this was going to be such a difficult engagement for me to take on. But often I, use all my resources, all my experience, come up with an objective evaluation of what the solution should be. And I'm surprised that a lot of times executives sit there and go, okay, all right, if that's what it is, let's move ahead.
Right.
And it's because somebody objective stepped in and gave an objective opinion on what should happen. And sometimes you just need that separation of somebody, of a party that's separate and not biased at all.
Right.
And that helps the situation. The other sort of story that I'll quickly tell is that to be very careful not to let an emotional decision destroy your business. Mm-hmm. I recall a situation where an employee was terminated, and then it was given a severance package, and the employee came back, countersued, and claimed wrongful dismissal and accused the owner of discrimination.
Right.
Well, the owner obviously took that personally. And going forward, every day when we were in meetings, whether it was operations, finance, accounting, as soon as the phone rang and it was a lawyer, he went, I got to take this. And he would walk out and be gone for an hour, 2 hours.
Oh, God.
And that became his only priority, was to deal with his lawsuit and make sure that this employee gets zero. And if you act on principle, you may feel like, okay, this is the right thing to do, but you're also in the process tanking your business. You're letting it slip. You're not focusing on core operations. And sometimes you need somebody to keep you in check and go, you know what? Maybe you should settle. I know you feel the employee does not deserve anything, but let's settle, move on, so that we can focus on growing the business, because that is what's the best thing for your company and for your employees. Absolutely. And that's a really difficult thing to keep in check for our business owner.
Absolutely. Thank you for sharing that interesting story. Would obviously help our listeners as well to keep a little reminder in the back of their head. Now, Daryl, now that we've touched base on the emotional well-being and emotional health, let's talk about financial health. Now, I know that accounting plays a very huge part or huge role in impacting the financial health of a small business. Mm-hmm. Could you share some strategies or best practices that small business owners can use to maximize their business's value through effective accounting?
For sure, Maheen. The number one thing that we do with small businesses that come to us and say, how do I do better, is help them understand the gross profit margin.
Right.
So when you look at a profit and loss statement, there's revenue, variable costs, gross profit. Then there's fixed expenses, and then there's your net profit on the bottom. I find that a lot of business owners know their revenue and they know their net profit, but they don't necessarily know everything in between.
Right.
And the everything in between are the details that allow you to make impactful business decisions. So from a gross profit margin perspective, it's, do you actually understand on a margin level, direct cost, how much you're actually earning on each product, each service that you offer? And what is that versus your fixed expenses? And as an example, if you have two products and product A has a 50% gross profit margin and product B has a 30% gross profit margin, and I know for a fact that with product A, if I were to invest $3,000, I can double the revenue. Knowing that information allows me to make a decision about where I should put my resources. Well, I should be expanding into product A. Mm-hmm. And without having that knowledge, even if you raise capital and you raise $3 million, you won't know what to do with it. You'll be guessing. You'll be throwing shots in the dark. So I make it a point for the business owners to fully understand gross profit margin on every product and service and how that relates to their fixed expenses like rent.
Right.
And separating the two between variable and fixed. That's one of the most important exercises any business owner can go through when they want to understand their business and how to improve their valuation.
Now, Daryl, are there a specific financial matrix or ratios that small business owners should pay close attention to when evaluating their company's performance and potential value?
Yes, and I'm going to go to ratios, but I'm also going to talk a little bit about the balance sheet, understand the balance sheet. So in response to the ratios first, I've already talked a bit about the gross profit on the profit and loss statement.
Right.
So I'll focus on the balance sheet. The two ratios that I would think about are the current ratio and the debt to equity ratio.
Mm-hmm.
The current ratio provides basically a snapshot of your current assets and your current liabilities. So in a pinch, in the short term, would I be able to cover all my short-term liabilities like 30-day payables, 60-day payables, payroll in a pinch? And usually I like that ratio to be at least 1.2 because that means that your current assets have a 1.2 times coverage over your short-term liabilities.
Right.
The debt to equity is a more of a long-term. And so it is the same concept, except that a lot of these debts and a lot of these assets and equity could be up to 5 years. So I like that ratio to be no more than 2-to-1 for a debt and equity perspective. And it's also important because it gives you flexibility if you would decide you want to apply for bank financing or if you want to take on more debt from an investor. A lot of people like the option of debt because it doesn't dilute their equity.
Mm-hmm.
When you raise equity, you lose ownership.
True.
So to the extent that you keep your debt in check, that is effectively how you keep the flexibility to bring on more debt and more bank financing instead of having to raise capital through the equity markets. The other quick point I want to make on the balance sheet is, again, I think a lot of business owners don't fully understand the balance sheet,
mm-hmm.
and it is to their detriment when they approach investors because the balance sheet effectively is like a net worth statement. It's a scorecard of what your business is worth because you have your assets, liabilities, and your equity. And so for a lot of things like intangible assets, when a business owner decides to invest $20,000 into a website or they invest in R&D, an accountant who knows what they are doing will know to capitalize that expense and put it onto the balance sheet as an intangible asset. Right. So it shows up under fixed assets. A bookkeeper will look at an invoice and just expense it. Mm-hmm. It will hit the profit and loss statement and it'll look like a loss, right. Whereas it's an investment. So I've gone through this process before, and this is a bit of a cautionary tale, but if you show your balance sheet and it's showing no fixed assets and you say, well, no, I've got R&D, I've got equipment, I've got, I've got a fridge, I've got different things, but your balance sheet showing zero and under fixed assets, it just begs the question of whether what you're saying is true.
Mm-hmm.
And it also shows that you've paid no attention to your accounting.
Right.
So already you're giving the wrong message as a result. So I say the advice that I give, not only on ratios, is to make sure that your balance sheet properly captures all the assets that you possess in your business. And a lot of times if you just leave it to a bookkeeper, that's not going to happen.
Right. Now, we'd love to break it down, this entire documentation process, Daryl, for
Mm-hmm.
our audience. When it comes to preparing a small business for sale or seeking investment,
Yeah.
What are some key accounting and financial documentation that entrepreneurs should have in order?
So there's 3 typical documents that people should be prepared. 1 is the business plan. 2 is an investor presentation. That's usually about a 12 to 15 slide PowerPoint presentation. And 3rd is a financial model, generally 3 to 5 years.
Okay.
The biggest disconnect when we consult people raising capital is that the financial model often does not speak to the business plan. So as an example, you will go through an investor presentation and it will say, in year 3, we're going to bring manufacturing in-house. Then I go to the financial model and there's no CapEx for
Mm-hmm.
manufacturing in year 3. So I think what happens a lot of times is people don't put a lot of effort into the financial model because they think, well, I don't have a crystal ball. I can't see the future. So whatever I put in here is not going to be true anyway. So why should I put so much effort into this? I'll just do my hockey stick revenue graph.
Mm-hmm.
But the financial model shows how much you have thought out risks, how much you've thought out expenses in the future as your business grows. And really, it answers the question of whether you are the right person when the business grows from 5 staff to 10 staff to 20 staff to 30 staff. Because, a lot of entrepreneurs show they're good starters of businesses, but you want to convince an investor that you are the right person when the business is medium size.
Right.
And that's a different skill set. So I encourage people to make sure that the financial model is built out really, really well.
But Daryl, many small business owners, they may not be too familiar with the financial planning or the accounting principles per se. On a final note, and as we wrap up this conversation today, what resources or advice would you offer to those looking to improve their financial literacy and make better informed decisions for their business's value optimization?
I'm going to say something that not every business owner is going to want to hear. You have to know your accounting. Now, we've come across those business owners that go, oh, the finance question, ask my finance person. Right. I don't deal with that. I'm in sales. Ask my accountant. And I think, especially if you say that in front of investors, and in fact, a lot of them have their CFOs or a finance person answer finance questions, and they avoid them. And I think there are some repercussions of doing that. You give the impression that you don't care, that you're indifferent to financials. It's okay not to be an expert in accounting, but it's not okay to give the impression that accounting is not important to you. So I think a CEO needs to be able to answer general questions about gross profit margins, needs to understand how to answer questions about financial leverage, needs to know high level their total debt in the company, and simple questions like that. But what I encourage every entrepreneur to do is to print out your income statement and your balance sheet, open it up and go line by line and say, do I understand this? Do I understand this? Do I understand this? And if they don't, ask their accountant, what is this? Prepaid expenses on the balance sheet. What's in there? Why is that there? And at least get high level understanding of what every line item means and what's in there. Because I will say this, a lot of times business owners that leave everything to their accountant, I can almost guarantee their financials are inaccurate, because as a business owner, you are in the best position to know if your financial statements are accurate or not, because you know your business better than anybody else.
Correct.
There are things that no matter how good of an accountant you hire, there are things they will never know about your business.
Correct.
So I think it is essential for a business owner to understand. And we do this when we work with our clients. Our first meeting with our CEOs are often much longer, because we will go through the financial statement and go line by line and make sure they understand every line. And quite often, even going through this exercise, they'll be, oh, what? We're still paying for that? What? I didn't know we were still paying for that subscription. We should cancel it. Oh, we're still paying for this person? This person was terminated a while ago. Why are we still paying for that? And we end up saving $2,000-$3,000 a month on expenses just by going line by line through a profit and loss statement.
Wow.
So it really pays to know your financial statements. There's obviously courses that they can take. There's accounting courses for non-accountants that are basic level. They don't need to become CAs or CPAs, but they do need to high level understand the financial statements. I stress that. I think it's vitally important.
Wise words indeed, Daryl. Thank you so much for providing us with a valuable reminder that how important it is to have, some kind of financial or accounting literacy if you're your own business owner. But thank you so much for spending time with us and for your invaluable insights and your knowledge today.
Thank you, Maheen. I really enjoyed it, and I look forward to more sessions like this going forward.
Absolutely. And that's a wrap for today's episode of the Canadian SME Small Business Podcast with our special guest, Daryl Ching. We hope you found his insights on small business valuation and accounting strategies valuable. And before we sign off today, a big thank you to our exclusive partners who make this podcast possible. We'd like to extend our thanks to our exclusive banking partner, RBC, our shipping partner, UPS, and our accounting software partner, Xero, for their generous support. And of course, thank you to all our listeners for tuning in. We look forward to sharing more valuable insights with you in the future episodes. Until next time, stay tuned, stay informed, and keep growing your small business.